Welcome to our continuing YouTube video series on taxes and the law. My name's Christopher Neufeld of Neufeld Legal, and in this particular YouTube video we will be discussing capital gains tax in the United States context. And the reason I make specific reference to the United States is because capital gains taxes are highly jurisdictional specific, and these are jurisdictions that are based on nations. So, what is a capital gains tax? Well, it is the tax that is imposed on the capital gain. And as we previously discussed when discussing capital gains, that is the net realized from the proceeds of disposition of capital property less the adjusted cost base and any expenses or overlays incurred from the disposition process. And this results in your capital gain. Now, once you've determined what your capital gain is, subject to other offsets, because you might have capital losses that you are looking to offset. In a general perspective, you're looking at determining whether the capital gain was acquired on a short-term basis or a long-term basis. Where you have a short-term capital gain, such that you have only held the capital property for a year or less, the capital gain is taxed as if it were ordinary income. If you held the capital property for in excess of 1 year, you are then subject to lesser capital gains tax rates that are dependent upon your specific tax bracket. And for that purpose, you should be reviewing the applicable rates as are set out by the government, given the fact that the government has a tendency of adjusting and modifying rates over time. Now, one of the other aspects that you need to be considering is whether there are specific rates and exceptions available to the particular capital property that you have disposed of. One of the primary areas where you have specific exemptions in rates is with respect to owner-occupied real estate. There you should be reviewing the specifics of those particular incentives or lessening of rates, and so that you are not allowing yourself to be pulled in to a higher tax rate and paying more tax than is necessary. When it comes to collectibles such as art, antiques, jewelries, precious metals, and stamp collections, there is a standardized tax rate for them. That, let's say, at one point that was a 28% tax rate on those capital gains. What does this mean? Well, if your overall applicable tax rate is lower, you will have to pay the standardized rate on all your collectibles, whereas if your tax rate is higher based on your tax bracket, you also will have to pay this standardized tax rate for those collectibles. Meanwhile, as to investment real estate, there are opportunities to claim depreciation deductions relative to the property's deterioration in value. This is another area where you should obtain specific guidance and direction from professionals so that you're making the correct choices with respect to reporting of those capital gains and the taxes allocated thereto. Meanwhile, when you deal in greater wealth and deal in more sophisticated aspects, including various investments, there are a range of additional taxes and additional aspects and liabilities that can come around, that this simplistic, in some respects, overview of what capital gains taxes are may not adequately address. As such, the more complex your investment portfolio, your earnings in the particular year, the greater they have been, the more important it is to obtain knowledgeable and professional advice in that regards to determining what your capital gains are. At the same time, you have to be looking at what your capital losses were. So that means when you look at the proceeds of sale from a particular disposition and those proceeds were less than your initial adjusted cost base, and taking into account any outlays or expenses in the sale, you may have certain capital losses, and these need not be in the current year but in other years that you may be able to utilize to specifically offset capital gains that you attained in a particular year. And this netting effect can effectively reduce, if not eliminated, the amount of capital gains and thus the amount of capital gains tax that would otherwise be payable. This is an important consideration to be taken into account and should be looked at judiciously and appropriately with knowledgeable professionals. There are other potential opportunities in the United States tax planning system to utilize your capital gains taxes, which can include various types of retirement plans that are available to yourself to structure and reduce your tax exposure. Looking at 401ks, Roth IRAs, traditional IRAs, and other tax strategies that may be available to yourself. But they are matters of consequence that you should be planning for. Similarly, you should be looking at other planning strategies where possible, given that sales timings can have a significant impact on the overall results of your tax payments. With that being said, I hope you have found it informative as to what capital gains taxes are in the United States and how, with increased complexity, there is a need for greater professional advice and analysis to optimize your tax position and properly minimize, as legally permissible, your tax exposure. Thank you.